Hi, I'm Jim Simons. I'm 67 years old, and I've spent the better part of my life proving that mathematics can decode the mysteries of financial markets. I built Renaissance Technologies from the ground up, transforming it into the most successful hedge fund in history, not through gut feelings or market gossip, but through rigorous data analysis and mathematical models. I've made billions by trusting numbers over narratives, and I've learned that the principles that create wealth are replicable, teachable, and entirely logical. Today, I want to share something deeply personal with you. If I lost everything tomorrow, every dollar, every asset, every connection, here's exactly what I would do in the next 90 days to rebuild from zero. I've watched thousands of investors over the decades, brilliant minds with Ivy League degrees and decades of experience, lose fortunes overnight. I've seen them panic, freeze, or worse, double down on the same emotional decisions that destroyed them in the first place. The question isn't whether you'll face financial devastation in your lifetime. Statistically, most people will experience at least one significant financial setback. The real question is whether you have a systematic recovery plan based on logic rather than hope. Most people don't. They rely on motivation, positive thinking, or waiting for luck to turn around. That's not a plan, that's a prayer. And in my experience, the market doesn't answer prayers. It responds to patterns, probabilities, and disciplined execution. The reason most recovery attempts fail isn't lack of effort, it's lack of structure. When people lose money, they enter a state of emotional chaos. Fear dominates their decision-making. They either become paralyzed, unable to take any action, or they become reckless, chasing high-risk opportunities to recover quickly. Both approaches are mathematically destined to fail. What separates those who recover from those who don't isn't talent or luck. It's having a predefined system that removes emotion from the equation. Today, I'm going to walk you through my exact 90-day recovery framework. This isn't theory. This is the same logical architecture I would use if everything disappeared tomorrow. 3 phases, each 30 days, each with specific objectives measured by clear metrics. No motivational speeches, no wishful thinking, just mathematics, discipline, and systematic execution. Let me start with a fundamental truth that most people resist accepting. Your current financial position, whether abundant or desperate, is the mathematical result of your past decisions compounded over time. This isn't about blame, it's about causality. Every financial outcome has identifiable inputs. The decisions you made, the information you processed, the risks you took, the discipline you maintained. These inputs produced your current output. If you want a different output, you must change the inputs. This sounds obvious, but most people never internalize it. They blame external factors. The economy, their boss, bad timing, unfair systems. While external factors exist, focusing on them is strategically useless because you can't control them. The only variables you control are your own decisions and actions. My 90-day plan operates on one core principle: identify the highest probability actions that generate measurable progress toward financial recovery. Then execute them without emotional interference. Day 1 through 30. This is the foundation phase, and it's the most counterintuitive part of the entire plan. Most people, when they lose everything, immediately start looking for ways to make money. They update resumes, apply for jobs, look for investment opportunities, anything that might generate income quickly. That's exactly backward. Before you can rebuild wealth, you must rebuild your decision-making infrastructure. You need to audit your cognitive processes, identify the systematic errors that led to loss, and install new mental frameworks that prevent repetition. I call this the diagnostic phase. You're not treating symptoms, you're diagnosing root causes. Here's how I would spend the first week. I would take a blank notebook and conduct what I call a failure autopsy. I would write down every significant financial decision I made in the 12 months before losing everything. Not just the big ones, every decision where I allocated time, where I allocated money, what information I consumed, what advice I followed, what risks I took, what risks I avoided. Then next to each decision, I would write 2 things: the expected outcome when I made the decision and the actual outcome. This creates a pattern map. Most people never do this because it's uncomfortable. It forces you to confront your own errors without the protective cushion of excuses. But discomfort is irrelevant. What matters is information. You're extracting data from your own history. Let me give you an example that illustrates why this matters. Early in my career before Renaissance, I made several investments based on what I thought were logical assessments of company fundamentals. I lost money on most of them. When I conducted my own version of a failure autopsy, I discovered something critical. My decisions weren't actually based on data. They were based on narratives that felt logical. I was investing in stories I found compelling rather than patterns. I had verified statistically the companies had charismatic founders. The industry seemed innovative. The business models sounded revolutionary. But when I looked at the actual numbers, the historical performance data, the probability distributions of similar ventures, the math didn't support my decisions. I was making emotional choices disguised as rational ones. That realization changed everything. It led me to build Renaissance on a completely different foundation. Never invest based on narrative. Always invest based on statistically verified patterns. That single insight born from honest failure analysis became the cornerstone of billions in returns. Your failure autopsy will reveal your own systematic errors. Maybe you overestimate your ability to predict market movements. Maybe you underestimate the impact of fees and taxes. Maybe you take advice from people who sound confident but have no track record. Maybe you confuse activity with progress. Whatever the errors are, you must identify them with precision. Write them down. Quantify them if possible. How much did each type of error cost you? How frequently did you make each error? This isn't about guilt. It's about creating a database of your own cognitive bugs so you can patch them. The second week of phase 1 is about information diet reconstruction. One of the biggest mistakes I see people make is consuming massive amounts of financial information without any filtering system. They watch market news, read investment blogs, listen to podcasts, follow dozens of analysts on social media. They think more information equals better decisions. It doesn't. More information without a processing framework equals more noise. And noise degrades decision quality. I would spend week 2 identifying and eliminating every source of information that doesn't meet 3 criteria. It must be data-driven rather than opinion-driven. It must have a falsifiable track record. And it must be relevant to decisions I can actually make. Everything else gets cut. No exceptions. This is hard for most people because they're addicted to the feeling of being informed. But being informed and being effective are not the same thing. In fact, they're often inversely correlated. The most effective investors I know consume very little information, but they process what they consume with extreme rigor. Week 3 is about building what I call a decision protocol. This is a written set of rules that governs every financial decision you make going forward. Think of it as an algorithm for yourself. Before I make any significant financial decision, even today with all my resources, I run it through a protocol. Does this decision have positive expected value based on historical data? What's the downside risk? What's the maximum I'm willing to lose? What evidence would prove this decision wrong? What's my exit strategy before I enter? These questions aren't suggestions. They're mandatory checkpoints. If I can't answer them clearly, I don't proceed. Most people skip this step because it feels bureaucratic. They want to stay flexible, to trust their instincts, to move quickly when opportunities appear. But that's exactly how you lose everything. Speed without process is just chaos with momentum. My protocol has saved me from countless bad decisions, not because it makes me smarter, but because it makes me consistent. The 4th week of phase 1 is about skill acquisition, but not the skills you think. Most people would use this time to learn about investing strategies or business models. That's not what I would do. I would use week 4 to learn one specific skill that has the highest probability of generating income within 60 days regardless of market conditions. This means identifying what economists call market inefficiencies in labor or service markets. What do people need right now? What are they willing to pay for? What skills can I develop quickly that meet that need? The key is specificity, not vague goals like start a business or become a consultant. Concrete, measurable skills tied to observable demand. For example, if I notice that small businesses in my area were struggling with online presence, I might spend week 4 learning basic website optimization and local SEO. Not because I want to become a career web designer, but because it's a skill I can monetize within 30 days while I execute the rest of my recovery plan. The goal of phase one isn't to make money. It's to build the infrastructure, mental and practical, that makes sustainable wealth creation possible. Now we move to day 31 through 60. This is the execution phase. You've diagnosed your errors, cleaned up your information sources, built a decision protocol, and acquired a monetizable skill. Now you test everything under real conditions. This phase has one primary objective: generate positive cash flow while maintaining zero tolerance for emotional decision making. Notice I didn't say generate maximum cash flow. I said positive cash flow. The amount doesn't matter yet. What matters is proving to yourself that your new system works. You're building evidence that disciplined execution produces results. This evidence becomes the foundation of confidence. And confidence, when properly calibrated, accelerates execution. Here's how I would structure days 31 through 45. Every single day, I would execute one income-generating activity related to the skill I developed in week 4. One client outreach, one service delivery, one optimization of my offering based on feedback, one per day, no exceptions. This sounds simple, but it's psychologically demanding. When you're in financial crisis, you want big wins immediately. You want the one deal that changes everything. That mindset is poison. It leads to desperation, and desperation leads to bad decisions. Instead, you need small, repeated wins that compound. Think about how Renaissance operates. We don't make money through massive bets that occasionally pay off. We make money through thousands of small edges that we exploit consistently. Each edge might generate a tiny return, but when you stack them with discipline and frequency, they produce extraordinary results. The same principle applies to personal recovery. Small daily actions executed with precision compound into financial stability. During this period, I would also implement what I call the feedback loop discipline. After every transaction, every client interaction, every service delivery, I would spend 15 minutes documenting what worked and what didn't. Not feelings, data points. Did the client respond better to approach A or approach B? Did pricing structure X generate more interest than pricing structure Y? Which marketing channel produced the highest conversion rate? I'm building a personal data set about what produces results in my specific context. Most people never do this. They repeat the same approaches indefinitely, wondering why they're not getting different results. That's not how systems improve. Systems improve through measurement, analysis, and iteration. By day 45, you should have enough data to identify your highest performing activities. Then you double down on those and eliminate the rest. Days 46 through 60 are about scaling what works. You've identified activities that generate positive returns. Now you increase frequency and volume. If one client outreach per day generated 3 clients in 2 weeks, what happens if you do 3 outreaches per day? If a particular service offering sold well, can you deliver it more efficiently? Can you raise prices without reducing demand? These are empirical questions. You test them systematically. The goal is to reach a point where your monthly income exceeds your minimum survival expenses. This is a critical threshold. Once you cross it, you're no longer in crisis mode. You're in building mode. The psychology changes completely. You're no longer operating from fear. You're operating from data-driven optimization. Let me share something that happened in the early days of Renaissance that illustrates this principle. We had identified certain mathematical patterns in currency markets that seemed to predict short-term price movements. The edge was small, and many of our competitors dismissed it as insignificant. But we recognized that small edges, when exploited with sufficient frequency and discipline, become substantial. So we didn't look for bigger edges. We looked for ways to exploit the small edge more frequently. We improved our execution speed. We reduced our transaction costs. We increased our trading volume in positions where the edge was strongest. Each optimization was incremental, but together they transformed a marginal strategy into one of the most profitable trading systems ever created. The same logic applies to personal financial recovery. You don't need a revolutionary business idea or a lucky break. You need to find something that works at a small scale, then systematically increase its frequency and efficiency. Now we enter the final phase, day 61 through 90. This is the expansion phase. You have positive cash flow. You have a proven system. Now you build leverage, but not financial leverage, operational leverage. This means structuring your activities so that incremental effort produces exponentially greater results. There are three forms of operational leverage I would focus on: automation, delegation, and expertise positioning. Let's break down each one. Automation means identifying repetitive tasks in your income-generating process and systematizing them. If you're manually sending the same information to every potential client, create a template. If you're repeatedly answering the same questions, create documentation. If you're doing the same calculation multiple times, build a spreadsheet or script. Every hour you save through automation is an hour you can allocate to higher value activities. Most people resist this because automation requires upfront time investment. They think it's faster to just do the task manually each time. That's short-term thinking. When you automate a task that takes 30 minutes and you perform it twice a week, you save 52 hours per year. That's more than a full work week. Multiply that across multiple tasks and you've created significant capacity for growth. Delegation is harder when you're recovering from financial loss because you have limited resources to pay others. But delegation doesn't always require money. It can involve trading services, bartering expertise, or partnering with people who have complementary skills. The key is recognizing that your time has different values for different activities. If you're earning $50 per hour from client work, but you're spending 2 hours per week on administrative tasks that someone else could do for $20 per hour, you're losing money by doing it yourself. Even if paying someone creates short-term cash flow pressure, the long-term math favors delegation. You free up time to generate more revenue. This is basic opportunity cost analysis, but most people don't apply it to their own labor. Expertise positioning is the most powerful form of leverage, and it's entirely within your control. In days 61 through 90, I would focus on becoming visibly expert in the specific skill or service I've been monetizing. This doesn't mean becoming the world's leading authority. It means becoming the obvious choice within a specific niche. How do you do this? By creating content that demonstrates competence. Write articles, record videos, share case studies, publish insights. Give away your knowledge freely. This seems counterintuitive. People think if you give away your expertise, no one will pay you. The opposite is true. When you demonstrate expertise publicly, you build credibility that attracts higher paying opportunities. You shift from chasing clients to having clients seek you out. The economics change completely. Instead of competing on price in a crowded market, you command premium rates because you're perceived as specialized and valuable. Here's something most people don't understand about expertise. It's not about knowing more than everyone else. It's about communicating what you know more clearly than everyone else. I'm not the smartest mathematician who ever lived. There are people with deeper theoretical knowledge than I have. But I understood how to apply mathematical principles to financial markets in ways that were communicable and executable. That's what built Renaissance. Not superior intelligence, but superior clarity of application. When you position yourself as an expert, you're not claiming to be the best. You're claiming to provide clear, reliable solutions to specific problems. That's a much more defensible and valuable position. By day 90, if you've executed this plan with discipline, you should have achieved 3 measurable outcomes. 1, you have consistent monthly income that exceeds your minimum expenses. 2, you have systems in place that reduce the time required to maintain that income. 3, you have visibility and credibility that positions you for higher value opportunities. You're not back to where you were before the loss. You're in a fundamentally stronger position because you've built wealth on a foundation of systematic thinking rather than luck or momentum. Now, I need to address something that's probably occurring to you. This plan requires enormous discipline. It requires doing things that feel uncomfortable, slow, or bureaucratic. It requires resisting the urge to take shortcuts or chase quick wins. Most people can't sustain this level of discipline for 90 days. They start strong, but by week 3 or 4, they revert to emotional decision-making. They see an opportunity that promises fast returns and abandon the plan. They get discouraged by slow progress and quit. This is why most people who lose everything never fully recover. Not because recovery is impossible, but because they lack the psychological infrastructure to execute a recovery plan. So how do you maintain discipline when everything in you wants to deviate from the plan? You use what I call commitment mechanisms. These are structures you put in place before you need discipline. that make it harder to make emotional decisions. For example, you could share your 90-day plan with someone you respect and give them permission to hold you accountable. You could tie financial penalties to deviation from the plan. You could publicly document your progress so that abandoning the plan has social cost. These mechanisms sound extreme, but they work. They externalize your future self's discipline requirements, so your present self has to comply. I've used versions of these throughout my career. When Renaissance developed a new trading model, we didn't just start trading it with our full capital. We set strict limits on position sizes and required multiple layers of verification before increasing risk. These weren't just guidelines. They were hard constraints coded into our systems. We removed the human ability to override them in moments of overconfidence. That's how you maintain discipline. You make it structural, not aspirational. There's one more element of this 90-day plan I need to emphasize, and it's perhaps the most important throughout this entire process. You must maintain what I call emotional neutrality toward outcomes. This doesn't mean you don't care about results. It means you don't let results dictate your emotional state or your next decision. If you have a good week, you don't celebrate prematurely or increase risk. If you have a bad week, you don't panic or abandon the plan. You simply observe the data, analyze what it tells you, and adjust your actions accordingly. This is extraordinarily difficult for most people because humans are wired to have emotional responses to gains and losses. But emotional responses are the enemy of systematic wealth creation. They introduce randomness into your decision-making. They make you inconsistent, and inconsistency over time guarantees mediocre results. I learned this lesson through mathematics long before I applied it to finance. In mathematical research, you can spend months working on a proof that goes nowhere. You can feel certain you're on the right path, then discover a fatal flaw that invalidates everything. If you let those failures affect your emotional state, you become paralyzed. You stop taking intellectual risks. You stop exploring new approaches. The mathematicians who make breakthroughs are the ones who can experience failure without internalizing it emotionally. They see failure as information. It tells them which approaches don't work, which narrows the space of approaches that might work. The same principle applies to financial recovery. Every setback is data. Every unexpected outcome is information. If you can train yourself to process that information without emotional interference, you gain an enormous advantage over everyone else who's letting fear and hope drive their decisions. Let me bring this all together. If I lost everything tomorrow, I wouldn't panic and I wouldn't hope. I would execute a systematic 90-day recovery plan built on 3 phases. Phase 1, days 1 through 30, is diagnostic. I would identify the systematic errors that led to loss, clean up my information sources, build a decision protocol, and acquire one monetizable skill. Phase 2, days 31 through 60, is execution. I would generate positive cash flow through disciplined daily actions, build a data set of what works, and scale successful activities. Phase 3, days 61 through 90, is expansion. I would create operational leverage through automation, delegation, and expertise positioning. By day 90, I would have income exceeding expenses, systems that work without constant effort, and credibility that opens higher value opportunities. This isn't a guarantee. There are no guarantees in financial markets or in life, but it's a high probability path based on mathematical principles and decades of observation. The difference between people who recover from financial devastation and those who don't isn't talent, luck, or resources. It's having a systematic approach that removes emotion from decision M. Most people operate on feelings. They make decisions based on fear when they should be analyzing probability. They make decisions based on hope when they should be examining evidence. They mistake activity for progress and motion for direction. A systematic approach eliminates these errors. It gives you clear metrics for success, clear actions to take each day, and clear criteria for adjusting course when needed. I want you to think about your own financial life right now. You might not have lost everything, but are you building wealth systematically or accidentally? Are your financial decisions based on data or on narratives? Do you have a decision protocol that governs how you allocate money, time, and attention? Do you know which of your activities produce the highest returns and which are just consuming resources? If you can't answer these questions with precision, you're one bad event away from serious trouble. You might be fine right now because of momentum or luck, but systems built on luck eventually fail. The market, the economy, your industry, something will shift. And if you don't have systematic foundations, you'll be exposed. This is why I'm asking you to do something specific right now. I want you to like this video, but more importantly, I want you to leave a comment with one sentence describing the single biggest systematic error you've identified in your own financial decision making. Not a vague statement, a specific error. Maybe you invest based on tips from friends instead of verified data. Maybe you avoid risks so completely that you miss growth opportunities. Maybe you confuse being busy with being productive. Whatever it is, write it down publicly. This creates accountability. It forces you to articulate the problem clearly. And articulation is the first step towards solution. Once you've identified your systematic error, you can build a process to eliminate it. That's how change happens. Not through motivation or inspiration, but through honest diagnosis and systematic correction. The principles I've shared today aren't just about recovering from financial loss. They're about building wealth that lasts. Wealth that survives market crashes, economic downturns, and personal setbacks. Wealth built on mathematics, discipline, and systematic thinking rather than luck and timing. This is how Renaissance became the most successful hedge fund in history. Not through insider information or market manipulation, through rigorous analysis, systematic execution, and absolute discipline. The same principles that work at the institutional level with billions of dollars work at the individual level with a few $1,000s. The math doesn't change. The discipline doesn't change. Only the scale changes. So here's my final question for you. If you lost everything tomorrow, would you have a plan? Not a hope or a wish, but an actual systematic plan with clear phases, measurable milestones, and specific actions. If the answer is no, you're already in more danger than you realize. You're operating without a safety system. And in complex environments, whether financial markets or personal finance, operating without systems is a recipe for eventual failure. You might succeed for a while through luck or momentum, but eventually randomness catches up with everyone. The people who survive and thrive are the ones who built systems that work regardless of external conditions. I've given you the framework. 90 days, 3 phases. Diagnostic, execution, expansion. Each phase has specific objectives and concrete actions. This isn't theory. This is exactly what I would do if I started from zero tomorrow. Will you execute it? That depends entirely on whether you're willing to prioritize logic over emotion, systems over hope, and discipline over convenience. Most people won't. They'll watch this video, find it interesting, then continue making the same emotional decisions they've always made. But you have the opportunity to be different. You have the opportunity to build your financial life on the same mathematical principles that created billions in returns. The question is whether you'll take that opportunity or let it pass. Remember, wealth creation isn't magic, it's mathematics. It's not about luck, it's about probability. It's not about hoping things work out. It's about building systems that produce predictable results through consistent execution. That's what I've done throughout my career, and that's what I would do if I had to start over tomorrow. Now you have the same framework. What you do with it is entirely up to